So this is super simple, super basic. If you just set a recurring transfer, keep buying that one index fund every single month, you really don't even need to look at it. Yeah, the market tanked, crashed 50%, who cares? Hey, what's up guys? In this one, I want to talk about index funds. So I'm pretty much going to go over the basics and just why you should invest in them. So an index fund is basically a mutual fund or an ETF that mirrors whatever is in an index. In an index like the S&P 500, that's the top 500 US companies. And then like the NASDAQ or the Dow Jones. And the reason why index funds are a good idea is because people normally really suck at investing or trading. And they will make a whole bunch of mistakes. Buy at the worst times, at the highs, and then sell at the worst time, at the lowest lows. They will sell no matter what you tell them. So an index fund that you basically invest in regularly over time is gonna be way better than the average investor. So I'm gonna mainly focus on the S&P 500 because I believe in that the most. It's just the top 500 US companies. So if you believe in the US economy, you believe in US companies, then just keep it simple. Like that's what I believe in, that's what I invest in. So do your homework, whatever you wanna do, go for it. So historically, the S&P 500 has made about 7% every single year, maybe 9%, depends on where you're looking. That is historically better than anything else you can find, in my opinion. If you do a mutual fund that you think can get you more, but they're always constantly buying, selling, and they kill you with the fees. So if you buy an index fund, usually the fees are really, really low. No one is actively managing that one, buying or selling or trying to do anything. They are just mirroring whatever's in that index and just leaving it. So to get started, you have to open a brokerage account. So maybe like Charles Schwab or Robinhood or TD Ameritrade or Vanguard. Find one that works for you. For me, I went with Charles Schwab and I went with the S&P 500 index fund, SWPPX. That's the one I went with. There's a bunch of different ones. I'm gonna leave a link to an article that I found that has a list of a bunch of different ones. The one that I use is just, I decided on that. I had a Charles Schwab account, it just made sense. So I went with that. The fees are super low on that one. It's like 0.22%. And then what you should do is just dollar cost average. Basically, a set a time every paycheck or every month on the first, whatever, constantly put in the same amount. So the idea with that is over time, you're gonna buy on the highs, you're gonna buy on the lows, you're just gonna be constantly investing, you're gonna catch everything that pops, everything, even though it drops, but you're gonna buy at levels where it's on sale. You just accumulate a whole bunch of money over time. And the main idea with that is also to start as soon as you can. You wanna get in on this when you're young, ideally, because so you give it time to grow. Okay, so for an example, I'm gonna go with the compound calculator. So we'll see how just a little bit of money will compound over time into a whole bunch of money. So you wanna start early. The main key to this is the time. So the earlier you start, the less money you're gonna have to put into it. So let's try one example. So let's just say you got 30 years to do this and you get about 7%. Let's just be conservative. Maybe you'll get more, maybe you'll get less, but I think that is a really conservative number to go with if you're going with the S&P 500. You start with, you don't start with anything, but every single month you add $200 per month. So overall, you're gonna put in about $72,000 in that 30 years. But that 72,000 turned into 226,705. And the idea with this too is to come up with your own number. What is your goal? What are you trying to do? Are you trying to come up with money so you could do, real estate investing, or are you trying to do something so that you can retire, so that you could just do what you're doing now, work, but do some investing, and at the end of 30 years, you can actually retire with a good amount of money. So depends on what you're trying to do. But let's just say you're trying to retire. I think that's what a lot of people are, thinking about. What is your number? So maybe 226,000 is enough for you. But for a lot of people, depending on where you live, that might not be enough. So then you have to plug it in. You gotta give yourself more time. Hopefully you start it like as soon as you can, like at 18, and you start investing in this. But if not, depends on how much time you got. So let's just say we're keeping the time the same in this example. And then I'm gonna go with, let's just say $500 a month. If you can save, put aside $500 a month for 30 years at 7%, at the end of the day, you're gonna come with $566,000. So hopefully that's enough for you. But if not, then plug in your number that makes sense for you. So this is super simple, super basic. If you just set a recurring transfer, keep buying that one index fund every single month, you really don't even need to look at it. Yeah, the market tanked, crashed 50%. Who cares? Your thing is still gonna buy it constantly. You don't really have to do anything else. So if you're not doing anything else, at least buy some index funds. If you just saved your money in the bank and got 0.002% from a big bank and you didn't invest at all, your money is still gonna be losing value every single year to inflation. Especially these days with the Fed printing money like no tomorrow, we run the risk, the value of our cash going lower and lower over time. So even if you did nothing else and you just put in a saving, is losing money. So help your money to grow, to keep up with inflation by investing in index funds. There's a bunch of different ways to invest and make money, but the most simple, basic, at least just do an index fund. And historically, it's hard to beat, because the top 500 US companies has historically done really, really well. And the sooner you start, the better your chances are to come up with a whole bunch of money. And the later you start, it's still possible. You're just gonna have to come up with more money every single month to throw at this to save up the same amount. But if you started young, then you'll be really surprised that you only have to put in maybe a couple $100 a month and somehow you could end up with a lot of money. All right, so let me know what you think of this one. Thanks for watching and good luck out there.